Hi everyone, welcome back to Saheb Academy. Today in this 15th video of Consolidation chapter, we are going to solve this ICAI study material illustration 6, and of our series also this is the 6th problem. And here the main focus would be on the bonus issue, because in this question what's happening is bonus is given out of post acquisition profits. Normally what happens, if the question is silent, we always assume the bonus is given out of pre-acquisition. But sometime what happens is the question will give you specific hints, or the question will directly tell you that bonus is given out of post acquisition profits. So in that case, how you have to do the adjustment of bonus, that you have to understand properly. So that is what we are going to see over here. Okay, so let's begin. Now see here, let's read the question once. On 31st March 2021, P Limited acquired 1,05,000 shares of Q Limited for 12 lakhs. So with this we can understand P Limited is the holding company and Q Limited is the subsidiary company. And how many shares did the holding company acquire? 1,05,000 shares. For how much? For 12 lakhs. Fine. So this is the purchase consideration. Okay. The position of Q Limited on that date was as under. Okay. So here we have been given the information of the subsidiary company, and that too on the date of acquisition, isn't it? They told us, see here, on that date. Which date? This date. So this is the information of subsidiary on the date of acquisition. See here, PPE 10,50,000, current assets 6,45,000, 1,50,000 equity shares of rupees 10 each, fully paid 15 lakhs. So this is the equity share capital of the subsidiary company. How many shares are there in total? 1,50,000 equity shares. So let's just calculate the controlling percentage, holding percentage. How will you calculate that? See, holding has how many shares of subsidiary? 1,05,000 shares. So 1,05,000 shares divided by 1,50,000. Yeah, just take a ratio. 1,50,000, you get how much? 0.7. So 0.7 is the controlling stake of the holding company, right? So minority interest is how much? 30%. 70% is holding, 30% is minority interest. Okay, got it. Pre-incorporation profits 30,000. P&L balance 60,000, trade payables 1,05,000. So with this you can also understand that these reserves which are given over here, 30,000 and 60,000, these are what? These are pre-acquisition profits, or you can say pre-acquisition reserves. Why is that so? Because this detail is on the date of acquisition. So when holding company acquired the company, the subsidiary company already had the reserves of 30,000 and 60,000. So these are pre-acquisition completely. Is it clear? Yes. Then see here, P Limited and Q Limited give the following information on 31st March 2023. Look at the dates carefully. Look at the dates carefully. Dates are very important. First, they told us acquisition happened on 31st March 2021. And then they are giving us the detail over here after 2 years. Read the dates. 31st March 2021, and here it is 31st March 2023. See here. Here the acquisition happened 31st March 2021, and then after 2 years they are telling us something. See, they are telling us something over here. They have given this information, and the date is 31st March 2023. Okay, so see, equity shares of rupees 10 each, fully paid before bonus issue, 45 lakh in P, and in Q Limited it is 15 lakh. So you have to understand, on the date of acquisition the capital was 15 lakh, and then after 2 years also they are saying the capital is 15 lakh only. So what does that mean? It means that bonus issue has not been accounted for. Okay, you will come to know there has been a bonus issue, but here I'm just telling you in advance. Okay, you have to look at the capitals properly. Even if the question doesn't specify this before bonus issue, you have to understand, because in exams what will happen mostly, if they want to confuse you, they will not give you this before bonus issue, like they will not specify. You have to understand just by looking at the figures. Yeah, so see, on the date of acquisition it's 15 lakh, and then after 2 years on the date of consolidation also it is what? 15 lakh only in the accounting books. So that means bonus is not accounted for. Yeah, bonus is not adjusted. Fine. And then see, securities premium 9 lakhs, pre-incorporation profits 30,000. Okay, this is completely pre, right? There has been no increase something. Yeah, it will not happen. And then see, general reserve 60 lakh of P Limited, and of Q Limited it's 19 lakh 5,000. So now you have to understand, see, if you see on the date of acquisition, here there was no general reserve. Here there was no general reserve. But on the date of consolidation, yeah, on this date, after 2 years, we have a general reserve in subsidiary company of how much? 19,05,000. So immediately you should understand this is entirely what? Post acquisition. This is entirely post acquisition. See, here there was no, what do you say? Here there was no general reserve. And then they are saying here there is 19,05,000 general reserve. So that general reserve has come into the, the company in this entire 2 years. Is it clear? In this entire 2 years. Fine. You understood that. And then see profit and loss account balance 15,75,000 in P Limited. Okay, that's fine. 4,20,000 in the Q Limited. So P&L balance was 60,000 on the date of acquisition. So just check 4,20,000 P&L balance on the date of consolidation at last minus on the date of acquisition, that is 60,000. So if you subtract that, you come to know 3,60,000 P&L has been earned. This much profit has been earned in this entire 2 years. Okay. Trade payables 5,55,000, 2,10,000, PPE 79,20,000, 23,10,000, investment 1,05,000 equity shares in Q Limited at a cost of 12 lakh. Yeah, this is the investment in subsidiary, which will cancel right in the balance sheet. Current assets 44,10,000, 17,55,000. Yeah, that's all fine. That's simple. Now let's just see what is happening in the question. Those were the details. See here. Directors of Q Limited, directors of holding company made bonus issue on, sorry, not holding company, this is subsidiary. Directors of subsidiary company made bonus issue on 31st March 2023, that is at the end of the year. That is also one of the case. See, what's happening is the bonus issues happened at the end of the year. That is why it has not been adjusted in the final accounts of the subsidiary company. Okay, that's also kind of a hint. In the ratio of 1 equity share of rupees 10 each, fully paid for every 2 equity shares held on that date. So bonus ratio is what? 1:2. If you have 2 shares, then 1 share will be given to you for free. Is that clear? That was the bonus. 50% bonus has happened. What is the bonus ratio? 1 for every 2, 1 by 2. So that's equal to 0.5. Yeah, 50% bonus has been given. Fine. Bonus shares were issued out of post-acquisition profits. Bonus shares were issued out of post-acquisition profits by using general reserve. Now here the question is specifically telling you what has happened, how the bonus is given. But even if this last sentence was not there, that bonus is given out of post-acquisition, you have to understand by yourself that bonus is given out of post-acquisition. Why is that so? See, there's a proper idea over here. See, what's happening? The bonus is given after 2 years since the acquisition, isn't it? See, 1 year pass, 2nd year pass, here bonus issue is happening, isn't it? See, directors of Q Limited of subsidiary went for bonus issue on 31st March 2023. That's on the date of consolidation at last after 2 years since the acquisition. So that is why bonus is given out of post-acquisition profits by using the general reserve. Now what is the requirement of this question? See, the requirement is calculate as on 31st March 2023 cost of control capital reserve. Yeah, either goodwill or capital reserve will be there. So you have to prepare the working note number 2, and then minority interest, working note number 3, and then third, consolidated profit and loss account in each of the following cases. What cases? See, they have given you 2 cases, before bonus and after bonus. Okay, so both the cases you have to solve. But understand, if you have to prepare these working notes, then you must also prepare the first working note, that is AOP. You have to, otherwise you may make a mistake in these 3 working notes. Is that clear? So you have to prepare the first working note also. So let's do that. Let's just solve this problem. It's really simple and straightforward. It's not difficult. Okay, let's start. Now see, here we have the solution. Let's start with the first case, that is before the bonus issue, which means you have to completely ignore the bonus. Solve the question as if bonus never happened. Okay, fine. The first thing you do is you prepare the shareholding pattern of subsidiary company. How do you do it? First, you take the total shares of subsidiary company on 31st March 2023 on the date of consolidation. Is it clear? Which is 1,50,000. How is it 1,50,000? Understand, on the date of acquisition, the total shares of subsidiary was how much? 1,50,000 shares. And then this is case 1, before issue of bonus, which means there has been no increase in the equity shares. It's exactly same. So on DOC also the same shares will be there, 1,50,000 only. Is it clear? Simple. So 1,50,000 shares. So if you just take a ratio, 1,05,000 divided by 1,50,000, that's equal to 0.7. That's the controlling stake of the holding company. 0.7 means 70%, and then minority interest is 30%. But you have to present it, right? You have to do the calculation over here. So it's really simple. You can easily calculate the minority shareholding, minority interest. How do you do it? Just subtract these two. 150 minus 1,05,000, you will get 45,000 as the balancing figure, which is what? Which is the minority interest shares. Okay, and the stake will be balancing figure. Directly you can take 30%. Fine. And then what you have to do after this, you have to begin the actual solution, the working notes. This was the working note number 0. You have to start with the first working note, which is what? AOP, or we call it as statement of net assets. Okay, so let's begin. It's really simple. How do you do it? We have a little bit different way. First, we take the date of acquisition column, and then we'll have post column. In that we'll have sub columns of each item over here: equity share capital, P&L, pre-incorporation, general reserve. Okay, and then we'll have date of consolidation column, just for the convenience to do the comparison. What do we do over here? We compare the information on DOA with DOC, and we'll understand what has happened in the post period, in the post acquisition period, and take the figures. Okay, so let's begin. On the date of acquisition, we have the information. See, date of acquisition information is given over here of subsidiary company. So equity was how much? 15 lakhs. Pre-incorporation profits 30,000. P&L balance 60,000. Just take that. 15 lakh, 60,000, 30,000. And then general reserve is also there in the question. See, but it is of the post. On the date of acquisition, there was no general reserve at all. So GR will be 0. GR will be 0. And then you have date of consolidation. See, on the date of consolidation, see, here we have 31st March 2023. Date of consolidation information of the subsidiary company, which is capital is 15 lakh only. They have not accounted the bonus. They have not done the adjustment of bonus. Is it clear? They have not recorded it. So that's why you have to take 15 lakh over here. But in this case, there is no bonus at all. So completely ignore that. Okay, so 15 lakh. And then P&L, how much is P&L? P&L balance is how much? 4,20,000 on date of consolidation. So take that, 4,20,000. And then pre-incorporation profits. Pre-incorporation profits is 30,000, same only. Okay, same only, 30,000. Okay, 30,000, same only. And then GR, general reserve, has become how much? From 0 to 19,05,000. So just take that, 19,05,000. Now do the comparison. 15 lakh, no movement in equity share capital. 60,000 and 4,20,000, movement is 3,60,000. This 3,60,000 is the entirely post acquisition profit and loss balance. Okay, the profit earned in the post period. So see, 4,20,000 minus 60, that's equal to 3,60,000. And then pre-incorporation, no movement at all. Of course, there will not be any movement. That's pre-incorporation profit. Okay, the profit that has been earned by the partnership or the sole proprietorship business before what? Before it was incorporated. So that's pre-incorporation. Of course, there will not be any increase in pre-incorporation profits. And then GR, 0 to 19,05,000. So there is entirely post movement, that is 19,05,000. Is it clear? Simple and straightforward. So just take a sum. 15 lakh plus 60,000 plus 30, that's equal to 15,90,000. And then P&L is 3,60,000. GR is 19,05,000. So that's the total. And date of consolidation, you don't take a sum because it was just for the comparison, just to see the movements. Okay, so DOC job is over. DOC column job is over. Fine. Now understand, in this question there is no bonus. In this question, I mean in this case, there is no bonus. There is no bonus adjustment, and nothing else has happened. Nothing, no dividend, no intragroup balances, nothing is there. No intragroup transaction, nothing has happened. So this is very simple and straightforward question, and there is no bonus also. Then it has become easy peasy, isn't it? So there will be nothing to do over here. Just directly take the share of holding and minority. Is it clear? And no time adjustment also. The main thing is that there is no time adjustment. See, understand what has happened over here. The date of acquisition is equal to the opening date, isn't it? 31st March 2021 and 1st April 2021 is same only. So the date of acquisition is on the opening date, so you don't have to do the time adjustment. Whatever has happened, that is completely post. This entire period is post, so there is no time adjustment. Okay, is it clear? No time adjustment. So that's also very simple, right? There is no time adjustment also over here. So whatever is there in the post column, that is post. You don't have to deduct something and add over here because it's not required. Date of acquisition is equal to the opening date. Now just take the holding percentage, that is 70% of each and everything. See here, 15,90,000 into 0.7, that's equal to, how much is it? It is 11,13,000. Yeah, and then just go on calculating 3,60,000. Yeah, of this PNL, 3,60,000 into 0.7, that's equal to 2,52,000. and then see GR 19,05,000 into 0.7, that's equal to 13,33,500. Yes, yeah. So the holding stake is done, and then you have minority stake 30% of everything, or you can just deduct 15,90,000 minus this, you will get 4,77,000. 3,60,000 minus this, you will get 1,08,000. 19,05,000 minus this, you will get 5,71,500. just take it as a balancing figure. You don't need to go on calculating with the percentages. Is it clear? Simple and straightforward. So you understood how you have to prepare the statement of net assets in this case. Really simple and straightforward. Now see the cost of control. It's very simple. How do you prepare cost of control? First you take the purchase consideration, cost of investment, that is 12 lakhs, isn't it? How did I get that 12 lakh? See, it's really simple. It's given in the question. They acquired the share, holding company acquired the shares for 12 lakh. This is the cost of investment, the purchase consideration, and it's also there in the balance sheet, 12 lakh. See here, investment 1,05,000 equity shares in Q Limited at a cost of 12 lakh. So what is this? This is the purchase consideration, the money they paid to acquire those 1,05,000 shares. Okay, so this is the cost of investment, and from this what you have to subtract? You have to subtract the net assets on the date of acquisition. Net assets on the date of acquisition, right? So if you just take this 12 lakh and subtract with this, what will you get? You will get 87,000 goodwill. Let me just show you. Here I want to explain you both the ways. Okay, see, understand. 12 lakh minus this, okay, net assets on the date of acquisition, that is 11,13,000. that will give you how much? 87,000. You see, 87,000 is the goodwill. Directly you can calculate like this, or what you can do, or you can go specifically. See, less net asset on DOA. What are net assets? Net assets are share capital and reserves, isn't it? So 70% of share capital you will take, 70% of share capital. So that means you have to look into the question. You have to look into the question. See, 15 lakh is there. This 15 lakh. Yeah, 15 lakh is there. So from this 15 lakh, I have to take 70%. 15 lakh into 0.7, that's equal to 10,50,000. Okay, see, 10,50,000, and then you have to take off the pre-profits. Now pre-profits, P&L and pre-incorporation, these are pre-profits, isn't it? 60 and 30,000. So 60 plus 30, that's equal to 90,000. So 90,000 into 0.7, that's equal to 63,000. So 63,000 is the 70% of pre-profits. So if you add up those two, you will get this much, 11,13,000. The same thing. See, this and this is same, isn't it? It's same, right? So that is why what I always suggest is just follow this way. Just prepare the statement of net asset. It will be really simple to you. Directly you can take the figures. If you would have directly taken over here like this, yeah, 11,13,000, just say pre-acquisition net assets on the date of acquisition, you will get the full marks only. Okay, so goodwill is 87,000. Is it clear? Simple. So you got cost of control, and you understood also both the ways how you can do it. Okay, it's just presentation, the same thing is happening. And then you have minority interest. Now how do you take the minority interest? It's really simple. If you do the shortcut way, it's really simple. Just take this, this and this, add up all of this, you will get how much? 11,56,500. Shall we do it? See, 4,77,000 plus 108, yeah, 1,08,000 plus 5 lakh, sorry, not 5 lakh, yeah, 5,71,500, that's equal to 11,56,500. See, 11,56,500. You see, you can do it like this, or you can just go into the question, look specifically, take each and everything separately, and you can do it. Okay, both the ways you have. Yeah, that's the same thing I have done now. See, 477, 1 lakh 8, 5 lakh 77. See here, the same figures are there over here, but it's separately. Okay, it's separately. See, share capital separate, pre-profit separate, revenue profit separates. Revenue profit means post profit, these two together. Okay, 1 lakh 8 plus 5 lakh 77,500, that is equal to 6 lakh 79,500. And pre-profits means 90,000 into 30%. Okay, and then 450. How did I get this 450? That is 15 lakh into 30%. Is it clear? Easy. And then you have consolidated reserves and surplus. So working note number 4. In consolidated reserves and surplus, what you have to do? You have to add the post general reserve, post P&L with the holding balance. Okay, see here. You have post P&L, that is 2 lakh 52, and here you have post general reserve. You have to add this with the holding balance. Yeah, what is holding balance? Holding reserves. Holding reserves are, see here, general reserve 60 lakhs, profit and loss account 15 lakh 75. So you have to consolidate them in working note number 4. So just take the holding balance first, 60 lakh and 15 lakh 75. To that you have to add the holding share in subsidiary company, but only post. Understand, only post, not pre. Pre is already considered over here. You have to just take this 2 lakh 52 and 13 lakh 33,500. 2 lakh 52 P&L to P&L and GR to GR. Okay, both the GR you have to consolidate and both the PL you have to consolidate of post only of the post column. So if you just add up these two, you will get 73 lakh 33,500, and here 18 lakh 27,000. Yeah, so that's the case 1. Really simple and straightforward. There was nothing over here. Now let's just go and move on to the case B, or you can say case B or case 2, that is immediately after the issue of bonus shares. Okay, let's see. Here we have the solution of the second case, or the case B, which is we have to solve the question immediately after the issue of bonus shares. It's really simple. First, let's see how much bonus issue has happened over here. It is 1 equity share for every 2 shares, isn't it? If you have 2 shares of the subsidiary company, then you will get 1 share for free. Okay, that's the proportion or the ratio of the bonus, 1 for every 2. Mathematically, we write that as 1:2 or 50%. Now, how will we calculate this? It's really simple. First, you have to take the total shares of subsidiary, that is 1,50,000 on the date of bonus, into 1/2. You have to take the ratio of bonus, 1/2 or 50% also you can take, 0.5. That's equal to 75,000 bonus shares. If you multiply with the face value, we'll get the value of bonus, that is 7,50,000. Yeah, bonus capital. Is it clear? Simple. And the first thing is we do shareholding pattern of subsidiary company. So it's really simple. First, what do we need? We need date of consolidation shares, right? Total shares on date of consolidation. How will we get that? You have to start with date of acquisition shares, give the bonus effect in that. Bonus issue happened now, so you have to give the bonus effect. Then only you will get the total shares of subsidiary on the date of consolidation. Is it clear? Simple. 1,50,000 is the shares of subsidiary on the date of acquisition, that is 1,50,000, right? And then bonus happened, so you have to add the bonus shares, that's 75,000. So just add that, you will get 2,25,000 as the total shares of subsidiary on the date of consolidation. Is it clear? And then you take shares held by holding company P Limited. The same way you have to do DOA plus bonus, you will get date of consolidation shares, yeah, held by the holding company of subsidiary company. Okay, right. So it's really simple. 1,05,000 shares they acquired now on date of acquisition. Add the bonus. How will you calculate the bonus? The same way. 1,05,000 shares holding has of subsidiary into 50% bonus was given, or 1/2 into 1/2, that's equal to 52,500. Clear? If you add that with 1,05,000, you get what? 1,57,500. You see this thing. Okay, so now what has happened over here? What have we done? We have got the total shares of subsidiary inclusive of bonus. Bonus is included in that, and here also it's inclusive of bonus. Both are inclusive. then only you can divide those two and get the proper controlling stake. Is it clear? That is what you have to do. Either you have to keep them exclusive of bonus, both, or both inclusive of bonus, then only you will get the correct stake. Okay, fine. And then how will you do the minority shareholding? Really simple. Just take 2,25,000 and subtract it with 1,57,500. You will get 67,500 as the shares held by the minority. And then just divide these two. Both are inclusive. So that will be 30% stake. So you see, the stakes before and after bonus is same only. Here also before bonus 70-30%, here also after bonus 70-30%. Why is that so? Because bonus is given out in proportion. Okay, it's given out in proportion. It's not given out randomly. There will be proper proportion, 1:2, 1:5, 1:10, like that. You all know that, right? So that was the shareholding pattern of subsidiary. You understood. Now let's start with the first working note, statement of net asset. The same way you have to do. See here, the same way. It's exactly duplicate. Yeah, exactly same. This first part is exactly same. On date of acquisition, see here, on date of acquisition, 15 lakh capital was there, 60,000 P&L balance was there, pre-incorporation profits, what, how much? 30,000. GR was 0. The same like the case 1. And on date of consolidation, 15 lakh capital. Yeah, now understand, you will be confused over here. Sir, why 15 lakh capital? This is case B, sir. This is case 2. Here bonus has happened. We have to do the bonus adjustment. Why are you not taking 22 lakh 50,000 over here? Because understand, 15 lakh is the capital that was there since date of acquisition, the total capital, plus the bonus capital 7.5 lakhs. So that's equal to 22 lakh 5,000. Sorry, 22 lakh 50,000. So why are you not taking 22 lakh 50,000 over here? Understand, it's really simple. In the question, if you see the information given to us on the date of consolidation of subsidiary company, the capital is 15 lakh, which means bonus is not accounted for. They have not done the recording of bonus. If bonus is not recorded, that means in the working note number 1 also you have to take it exclusive of bonus, without bonus only. Remember this. Okay, this is what you have to do. That is why I have not included the bonus over here. Bonus is not there in that. Simple. Okay, and then on date of consolidation, the P&L balance is how much? P&L balance is 4,20,000. Okay, 4,20,000. And then pre-incorporation is same, only 30,000. General reserve is how much? 19,05,000. See here, 19,05,000. Okay, easy. And then you will take a sum of everything. Yeah, see the movement first. 60 to 4,20,000. That means there is an increase of how much? 3,60,000. 0 to 19,05,000. So there is an increase of that entirely. And then just take a sum. 15 lakh plus 60 plus 30. That's 15,90,000. 3,60,000 over here. 19,05,000 over here. Date of consolidation purpose is over. So this is not there. This will be nil. Okay, the purpose of DOC was just to facilitate the comparison, just to make us understand how much is the movement in post column properly. Okay, fine. After this, you have to start with the bonus adjustment. There is nothing else over here. Just bonus adjustment you have to do right now, right? So how will you do the bonus adjustment? Let's just recap once. See the concept over here. Accounting treatment of bonus issue in CFS. What do you do first? Check the subsidiary's balance sheet and verify whether the bonus issue is already adjusted or not adjusted. What does that mean? It means, is it recorded or not recorded? If it is recorded, then you have to follow these steps. If it is not recorded, then you have to skip the first step. You will not do the reversal of bonus. Wrong, you will not do that. And you will start with the second step. Yeah, apply time adjustment, consider the bonus. Yeah, that means, deduct the amount of bonus issue from pre-profits, but here you will do post-profits because the source of bonus is from post-acquisition, isn't it? In the question it is said bonus is given out of post-acquisition profits. So that is why you have to, deduct the bonus from the post-profits. Is it clear? Okay. And then the fourth step is add the amount of bonus issue to pre-equity. Yes. Even though bonus is given out of post, still you have to add to the pre-equity only. Always remember this. Is it clear? And you all know bonus is always assumed to be paid out of pre-acquisition reserves, But in this question, what has happened? It is specifically mentioned, it is given out of post. So that is why we have to treat it like that. Okay, fine. So let's see how it will be done. It's really simple. We all know bonus is given out of post, and it is not accounted, it is not adjusted. Not adjusted means we will not do reversal of bonus, will not add back and all. Okay, so see what happens because of bonus. Because of bonus, reserves will fall and share capital will increase, right? So we are not going to do reversal of bonus. Directly we'll give the effect in third and fourth step. Okay, we'll just consider the bonus. So what we have to do, we have to decrease the reserves and increase the share capital. So see how will we do this? It's really simple. Which reserve you will decrease? You have to decrease the general reserve, post general reserve. By how much? By the value of bonus. 75,000 bonus shares were issued now into the face value, that's equal to 10. So that's 7,50,000. Okay, so 7,50,000 you have to subtract from the GR, you can see over here, and then you have to add back to the pre-equity. I mean, you have to add back to the pre-acquisition net asset. See here, 7,50,000 you are adding over here. Is it clear? 7,50,000 from subtracted from the GR and added back in the pre-acquisition net assets. Now you will have a doubt, sir, why are we not adding back over here in the post-equity column? Because understand, what do? We always subtract the bonus capital in the working note number 2, okay, from cost of investment. So that is why we have to add back over here. And the logic is really simple here. Understand, why are you getting bonus? You are getting bonus because you had acquired the shares with that cost of investment. Is it clear? That's also kind of a logic you can apply over here. Okay, fine. So you understood now. 7,50,000 subtracted over here and 7,50,000 added over here. You all know bonus is nothing but just shuffling of the net assets. Okay, no new thing is coming into the company. There is no increase or decrease in net assets, in the total net assets of the company because of bonus. It's just that you have converted the reserves into share capital, right? So you just decrease the reserve depending upon the source, that is post GR. So you deducted that. Okay, you deducted that over here and you added back over here. Okay, you have added, I mean you have increased the capital, okay, by the same amount, 7,50,000, 7,50,000. Is it clear? What you didn't do over here, you did not reverse the bonus because bonus was not adjusted, it was not recorded. So how will you reverse? There is nothing to reverse. You just have to record the bonus. Just record the bonus, just give effect of the bonus, that is deduct the reserves and add in the pre-equity. Is it clear? Pre-equity, fine, you understood. After this, what will happen is, after this you will take a sum, right? I mean, you will calculate 15,90,000 plus 7,50,000, that's equal to 23,40,000, isn't it? 15,90,000 plus 7,50,000, that's equal to 23,40,000. Okay, and then the rest is same only, 3,60,000. And here what will happen? Of course, it has been deducted from GR now. So 19,05,000 minus 7,50,000, that's equal to 11,55,000. Clear? Easy. So over. So now what you have to do, you just have to take 70% of everything and here 30% of everything for minority. You will get these figures. Is it clear? These figures you will get. All right, simple, fine. Now you can easily do that. After that, cost of control we have. Cost of control means the same thing. Cost of investment is 12 lakh as given in the question. They acquired it for 12 lakh. Yeah, so that's cost of investment. From this you have to subtract the pre-acquisition net assets on the date of acquisition. You will get either goodwill or capital reserve, isn't it? Yes. So if you see here, there is 16,38,000. So just subtract this from this 12 lakh, you will get 4,38,000 negative, which means it is capital reserve. Let's see this in the calculator. Yeah, this is the holding share na in the, see how did I get this 16,38,000? I took 70% of that. Okay, that's how I got 16,38,000. So let's see, 12 lakh is the cost of investment, right? Minus 16,38,000. 16,38,000. Both the ways I'm showing you. Okay, so that's equal to 4,38,000. You see, if you prepare statement of net assets, it becomes really simple to you. You can just write this minus 16,38,000. You would have got this 4,38,000. Okay. or you can go the comprehensive way where you write everything specifically. It's really simple. This is also simple. 70% of pre-profits. 70% of pre-profits means you will take the 60,000, 30,000, that's equal to 90,000 in total. So 90,000 into 0.7, that's equal to 63,000. Clear? 63,000. And then how did I get this share capital? Simple. Share capital means 15 lakh into 70%. 15 lakh into 0.7, that's equal to 10 lakh 50,000. You see, 10 lakh 50,000, right? So in total, this is how much? 11 lakh 13,000, right? Yes. And then bonus capital is subtracted separately. Yeah, always you have to subtract the bonus capital from the cost of investment in cost of control. Okay, otherwise your capital reserve or goodwill will be wrong. Fine. Always you have to subtract the bonus capital. So bonus capital was how much? Bonus capital was how much? 7,50,000 now. Bonus capital for holding, only holding share will be taken. Okay, not everyone's share. Let me just write that. Only holding share. Only holding share you have to take. Okay. So total bonus was actually how much? 7,50,000. But can you take entirely 7,50,000? No, only holding share, that is into 0.7, that's equal to 5,25,000. Isn't it? We saw in shareholding pattern now. See here, how much bonus they got? Holding, they got 52,500 bonus shares, right? So if you just 52,500 into 10, that's equal to 5,25,000, right? So 5,25,000 bonus you will subtract. Yeah, that's what happened now. See, here bonus is there in this 23,50,000, but in this, how much we have taken? Only what? 70%, nah? Only 70%. So that's why. So better is just take this 12 lakh, subtract 16 lakh 38, you will directly get this. Is it clear? Understood? So 12 lakh minus this, that's equal to 4 lakh 38. Both the ways you will get the same answer. It's just that you will save time and you will make less mistakes if you follow this way. Directly take this and subtract. Yeah, what's the big deal? It's really simple. So working note number 2 is over. Capital reserve 4 lakh 38. Simple. And then we have minority interest. Minority interest is really simple. As I've already told you, just take this, and this, and just add that. Yeah, see here, 7 lakh 2,000 plus 1 lakh 8,000. Yeah, this thing plus 3 lakh 46,500, that's equal to 11 lakh 56,500. 11 lakh 56,500. You see, it's the same. Yeah, isn't it? Yeah. So you see, minority interest did not change even before the bonus and after the bonus also. 11 lakh 56,500, 11 lakh 56,500. Okay, fine. And then we have Conso reserves and surplus. Yeah, consolidated reserves and surplus, or someone. Okay, consolidated reserves and surplus. Now what's happening over here? The same way. First you have to take the holding balance, that is 60 lakh and 15 lakh 75,000. You will get that from the question. See here, 60 lakh and 15 lakh 75,000, GR and PNL. Okay, GR and PNL. And then you have to add post GR and post PNL share of holding company. Yeah, which one is that? 2 lakh 52 and this thing. How much is that? 8 lakh 8,500. Okay, 8 lakh 8,500. So just add that. Yeah, see here, in PNL 15 lakh 75 plus 2 lakh 52. Let's do that in calculator. 15 lakh 75,000 plus 2 lakh 52, that's equal to 18 lakh 27,000. Okay, 18 lakh 27,000. And then 60 lakhs plus 8 lakh 8,500. Let's add it. 60 lakhs plus 8 lakh 8,500, that's equal to 68 lakh 8,500. Fine. This is the GR of the holding company now. GR of the holding company, the consolidated one. Clear? Okay. So this is how you have to do it. It was really simple and straightforward. It was not difficult. Okay. And I've explained in very much detail. Now some notes I have written over here. Understand, bonus is not adjusted in balance sheet. Yeah, it was not recorded in balance sheet. So do not reverse the bonus. We will not reverse the bonus. Just deduct it from the post GR and add back in the pre column, in the pre equity. Okay, that is what you have to do. And the second note is, see, cost of control has changed because bonus is given out of post acquisition reserves, isn't it? If bonus is given out of post acquisition reserves, then what will happen? Pre acquisition net asset will change, isn't it? If it was given from pre only, it would have been added in pre and deducted also from pre, so there will be no effect, nil effect. But here what's happening? The source is post, so it is deducted from the post and added in the pre. So that is why the there will be a change in the cost of control. See here the cost of control is what? Before the bonus cost of control was 87,000, goodwill was 87,000, and after the bonus what happened? Capital reserve, we got capital reserve of 4,38,000. Why is this change? Why there is a change? Because bonus is given out of post acquisition. Yeah, if it was given from pre acquisition, then there would have been no change at all, because here only you would have deducted and here only you would have added. Is it clear? That's the thing. Fine. So that's the thing regarding cost of control. It has changed because bonus is given out of post acquisition reserve, and minority interest, there is no change. Minority interest remains the same even after the bonus. Is it clear? Yeah, because it takes into account everything now, so that's why there will not be any change. Fine. And then we have working note number 4. Here what ICAI has done, ICAI has added post GR with consolidated P&L. They have consolidated all the reserves together, all the revenue profits. But that is not the ideal solution. What you have to do, you have to keep it separate, because in balance sheet you have to show it separately now. That is why in the working note itself you have to do it separately. What separately? GR with GR only, P&L with P&L only. But what the ICAI module has done, they have consolidated everything, just revenue profits they have said. Okay, but you don't have to do it like that. Okay, in the exam you have to keep it separate. Is it clear? You have to keep it separate. Okay, ICAI has added the post GR with consolidated P&L, but it is not the ideal solution. You have to keep it separate. Is it clear? Fine. So this was the illustration 6 of the ICAI study material, and also this question was there in the November 2021 RTP. Okay, you can see. So this is it. Fine. So that's it for this video. See you in the next video. Bye.